Let's look at trade policy itself. Now, of course, there were two big events in April related to trade policy. The first was the announcement on April 2nd of reciprocal tariffs on most U.S. trading partners. Then, of course, the subsequent announcement that most of those tariffs would be put on hold for 3 months. There was one big exception to that on hold policy, however, and that, of course, was China, where the baseline tariff, was raised at the time to 145%. This is important because China is a very important trading partner. U.S. China trade has actually diminished since the first round of this trade war in 2018, but it's still sizable. China still accounts for over 13% of U.S. imports. And so, even if tariffs on every other country on earth were to go to zero and a 145% baseline tariff on China were to remain in place, that would lift the weighted average U.S. tariff rate to nearly 20%, which would be up nearly 10x from where it is today or where it was coming into this year, and that would make the U.S. the fourth highest tariff country in the world, behind only Bermuda, the Solomon Islands, and the Cayman Islands. More importantly, it's not just that China is a sizable trade partner, it's a crucial trade partner. So you can see on this chart China's share of U.S. imports in certain categories. So, for example, looking at the far left-hand side of the page, China imports from China account for 70% of all toy imports. There was actually a survey this week by the Toy Association of small and medium-sized toy businesses that showed that half of these companies, 400 companies were surveyed, close to half of these companies said that if the current China tariff were left in place, they would go out of business in the months ahead. So a very important trading partner and one that could have big effects again if current policy is left unchanged in the months ahead. China is also an important source for U.S. manufacturers. Roughly 30% of all imports to U.S. manufacturing or roughly 30% of all inputs to U.S. manufacturing are imported, and roughly 1 in 6 of those, roughly 16% of those imported imports come from China. So a very important trade partner, and one that again feeds into the uncertainty that could be driving hiring, investment, and spending in the months ahead. Let's take a look at the next chart and look at what's actually happening with trade so far already after the announcement in early April. Here we're looking at container ships, the number of container ships departing China for the U.S. And you can see there was actually a big, little bit of a spike earlier this year in anticipation of the tariffs and as a way of front running the tariffs, a way of moving product from China to the U.S. before higher tariffs were put in place. But now, since then, in recent weeks, we've seen a relatively sizable decline in the number of container ships coming to the U.S. It's to be expected. This chart is going to show continued declines in the months ahead, but we're already beginning to see that turn here in the real economy. We should see in the trade numbers in the months ahead. So the risks here are elevated. We've got uncertainty over trade policy, and we've got a trade policy in place with one country in particular that could have big effects on U.S. manufacturing and the U.S. economy more broadly. The index of leading economic indicators and a number of other indicators. We've talked about the yield curve on this call. We've talked about consumer expectations on this call. We've talked about bank lending standards on this call. All of those indicators have been pointing to an elevated risk of a downturn for some time. We throw on the trade uncertainty, we throw the tariffs on top of that, and the risks are even more elevated going forward.
To watch this month's complete analysis and receive daily updates directly to your inbox, become a member at cycleframework.com.